Hi everyone, this is Hai Liang. Welcome back to my channel. Today I'll be sharing on the tips to analyze the financial statements of a Hong Kong listed company. Personally, I'm invested in a couple of Hong Kong listed companies, and the most common source that I go to retrieve financial statements is the official Hong Kong Stock Exchange website. Let me show you how to do it. First, you type in HKEX to search it on Google, and most likely it will be one of the top results appearing uh, at the top of the page. So just select the first result that you see on Google, and that will bring you to the official Hong Kong Exchange website. Oops. So under market data, key in the stock code that of the company that you are investing in. For example, I'm invested in this company called Greatview Aseptic, and the stock code is 468. So under company click on company under company announcement. There's a link over here. View all on HKEX News. Click on that, and you just have to scroll through to find the announcement for the interim report or the annual report. In this case, we will be looking at the annual report. If there are too many, you may actually search for the keyword over here. Simply type in annual report and press enter. And let's look at 2019 annual report. Okay, so this is how the annual report looks like. And usually, let's look at the content page. Usually the first few pages will be talking about the corporate information and a short summary. I particularly like the section about financial summary, as it really gives you a breakdown of all the key financial indicators such as revenue, gross profit, net profit, etc., in the current period, and as well as the comparative prior period. If you want to go further than 1 year, because the comparative period here is only 1 year ago. If you want to look at 5 years back, there is another financial summary called the 5 years financial summary. Usually it's found on the last page, but depending on the company, some companies actually put it before the financial summary over here. So for Greatview's case, it's actually on page 6, which is not at the back of the not at the end of the report, but rather it's at the top, it's at the front of the report. And this is something that I will usually look at before being invested in any of the companies. What I usually look out for is I want to look at an increasing revenue trend, as well as an increasing profit trend. Yeah. In this case, the revenue is not to although if you look at the 5 years time frame, revenue did increase from 2015 to 2019, but there were a few years where the revenue actually went down before it went up. So this is not really this is not something that I appreciate, and I actually prefer companies showing strong revenue growth consistently. Yeah. Another important metric that I will look at is the profit. The profit did not show the profit actually showed an increasing trend from 2015 to 2018, but it dipped from 2018 to 2019. As you can see over here, it's still to a drop in net profit margin, and that is not a good sign when you are actually looking for companies to invest. the ideal scenario would be a company showing a consistent increase in their net profit margin from um, yep. And so another thing that I will look at is when you are invested in a company, you are actually part of the equity holders of the company. And as equity holder, we would like to see the total equity growing, because total equity actually represents the total worth of the company, total value of the company. And in this case for Greatview, the picture isn't that rosy, because total equity actually grew marginally from 2.2 billion RMB to 2.5 billion RMB in 2019. So that is a very slow growth in my opinion, and this is because Greatview is a dividend is a high dividend company, and it pays out most of its profit to its shareholders in the form of dividend. Hence, it's understandable why the total equity actually did not grow much from 2015 to 2019. And if you are a dividend seeking investor, Greatview is actually a very good company to consider, because its dividend payout is almost 100%, if I'm not mistaken. Yeah, so okay. Usually, I will look at the CEO statements to understand the more about the prospects of the company, as well as having having a better understanding on the financial performance of the company. So this is a section that I will usually read through to gain more understanding on the financial results for the past year, as well as the future prospects of the company. So I recommend all of you to actually quickly run through this segment on CEO statement, as well as management discussion and analysis. Yeah, it's not very long, it's only a few pages here, and it's succinctly written, so it's good to have a look at them before dwelling into the financial statements. And these are the these are the pages that I usually skip because they are not very relevant. So I will go to the balance sheet as well as the income statement of the company. Okay, so here we are at the balance sheet of the company. Um, so in a company, the books of the company is actually made up of two or three segments, mainly known as assets, liability, and equity. And in accounting, there's one very important equation, and that is asset plus liability equals to equity. So a company, as mentioned earlier, the equity of a company is the total worth or value of that company, and that equates to total asset of the company minus total liabilities. Within assets and liabilities, we further categorize them into non-current assets and current assets, as well as non-current liabilities and current liabilities. So you may be wondering what current means. So based on accounting standards, current means something that will materialize within the next 12 months period. Say for example, inventory is classified as current assets because we expect economic benefits to flow into the company within the next 12 months, meaning to say that we expect this inventory to be turned into cash within the next 12 months. Hence, it's actually classified as current assets. Yeah. For things like property, plant, and equipment, we will usually classify it as a non-current asset because the property, plant, and equipment is something that that you depreciate over a very long period of time. Say for example, factory, the useful life could be could be as long as 25 years or even 50 years, depending on the condition, depending on depending on management's judgment on the useful life of the asset. So for these cases, we do not expect the entire asset value, the entire economic benefit of the asset to flow to the company within the next 12 months. Hence, we actually classify it as non-current. Same for trade receivables. Trade receivables. You may be wondering why trade receivables is split into two parts: non-current asset and current asset. This is because this segment of the trade receivables, 9,000, about, this is expressed in thousand, so it's about 9.8 million RMB. This this portion of trade receivables, the economic benefit is only expected, the economic benefit is expected to flow into the company after the next 12 months period. So in other words, it will not, the company, there won't be any inflow of economic benefit into the company for this particular item within the next 12 months. As an investor, the next thing I'll look at is the nature of the items on the company's balance sheet. So items such as intangible assets, trades, and trades receivables, these kind of assets are susceptible to impairment testing, which means that these assets might be written down in terms of its value when there's a deterioration in the macroeconomic indicators. In other words, a recession. So in a recession, your debtors may not be able to settle their payment on time. They may even default on their payment, and that's when you may have to write down your trade receivables value accordingly. Similarly, for intangible assets, the valuation of intangible assets may involve management's judgment, and management may be too optimistic when they derive the valuation of the intangible assets. So in the event of a recession, it may prove that the parameters used to derive the valuation of intangible assets are overly optimistic, and hence it may have to be written down in value to reflect the economic reality. And the difference between the carrying value and the value after writing down will go to the profit and loss statement, and the profit and loss for that particular year will look particularly terrible due to such write down in value of its asset. To summarize, as an investor, I don't prefer a company that has a huge amount of intangible asset sitting on its balance sheet, particularly intangible asset. It's actually normal for a company to have huge trade receivables sitting on its balance sheet, and one mitigating risk to address this is that if there are no history of debtors defaulting on its payment, I can tolerate a company having a huge trade receivable sitting on its balance sheet. However, for intangible asset, the risk for intangible asset is slightly higher, and I prefer not to invest in a company with huge amount of intangible assets sitting on its balance sheet, because that's like a ticking time bomb in my opinion. It can be written down anytime, and the difference will be flushed to profit and loss, which makes the profit and loss for that particular year look very terrible. The next thing that we would like to pay attention to would be the book value of the company. There is this very popular financial matrix called price to book ratio. So price to book ratio, this is taken from Investopedia, And price to book ratio measures the market valuation of a company relative to its book value. Usually, PB ratio, this in short is known as PB ratio. Usually, PB ratios under 1 are typically considered as cheap, and PB ratios over above 1 is considered expensive. So let me just do a rough calculation of PB's ratio of um, this company, Greatview Aseptic Packaging. So I will draw my Excel, and this is what I'm gonna do. I will take this figure and I will look at and I will minus off the liabilities, or you can simply take total equities figure. Yep, you take the total equities figure and you compare this figure against its market cap. If I'm not mistaken, this is in RMB. So the conversion from RMB to Hong Kong dollars is about 1.11 HKD to RMB. Okay, and this is the total equity. And the market cap is about, the market cap value can be obtained from the Hong Kong Exchange website over here. So the market cap for Greatview Aseptic Packaging is about 5.23 billion. Okay, let's okay, 5.23 B. Okay, so let's do a quick calculation. We need to convert this equity figure in RMB into Hong Kong dollar. So what we do is that we will multiply 1.11. So this is this figure over here is about 2.7 billion because it's actually expressed in thousand. This is expressed in RMB 1,000. So after we have converted it, this figure is in Hong Kong dollars, and the total equity, the total book value of Greatview Aseptic Packaging is about 2.7 billion. That means that it is trading at a PB ratio of around 5.23 divided by 2.723 of about 1.92. Based on PB ratio, based on the traditional reference value of 1, Greatview Aseptic Packaging is trading at a premium, and it is not that cheap. However, we also need to look at the PE ratios. Usually, I'll look at these two in conjunction, because PB ratio is just a measurement of its book. When you are not buying, in certain cases, when you invest in a company, you're actually not investing in its asset, but rather you're actually investing in the future cash flow of the company. There are different types of investment strategies. They are asset play. So for asset play, basically PB ratio is particularly important, because the sole reason why you are buying into this company, you are investing in this company, is because this company has very valuable assets on its balance sheet, and you are only interested in its asset. You are more interested in its asset. Hence, in those scenarios, we will focus more on the PB ratio. However, for Greatview, this is a dividend play. We are investing in its future cash flow, and PB ratio may not be that relevant. Hence, we will look at another ratio called the PE ratio. As you can see over here, the Hong Kong Exchange website actually shows you the PE ratio of the company, about 14 times. Based on my opinion, if you would like to invest in a company, the PE ratio that I generally prefer is not higher than 15 times. If the company shows great growth potential, It could I do not mind paying up to 20 to 25 times of the PE ratio, depending on the situation, depending on how high the potential growth rate of the company is. But for companies that do not show that for non-growth companies, companies that you do not invest for growth, you merely invest in the company for its dividend, I will prefer to buy at a price range of below 15 times PE. As shown here, the PE ratio is 14, but sometimes this can be misleading, and usually I do not rely on the figure provided by Hong Kong Exchange website. I prefer to calculate it on my own because that is the most foolproof method. So let me show you how I would do it. Let's go back to the annual report, and we will look at the income statement portion. Yeah, this is the statement of comprehensive income, and I will look at this particular line, profit attributable to owners of the company. This particular line over here, we do not care about other comprehensive income. The PE ratio calculation is actually based on the net profit, which is this line over here. And take note, it's net profit attributable to the owners of the company. We will need to less out the portion attributable to the non-controlling interest. In this case, there is no non-controlling interest, and hence it doesn't make a difference. So let's copy this figure over, 337319. Net income is 337319. Once again, we will need to convert this to Hong Kong dollars. So let's perform the conversion. And the market cap is about 5.23 billion. So we can, PE ratio would be calculated by dividing the market cap with the earnings, the profit attributable to the equity holders, to the owners of the company. So I guess we need to convert this to billions. Okay, let's convert it. 5.23 and then I think it's about another 60. And this is, we also need to times this with, we need to express this in thousand as well. Okay, so let's do it. Okay, so by dividing the market cap with the profit attributable to owners of the company in 2019, we actually arrive at a PE ratio of about 14, and this actually meet my criteria of investing in a company lower than PE ratio of 15. Also, do note that there are different types of PE ratio, and it's usually categorized into two main types: forward PE ratio and trailing 12 months PE ratio. Forward PE ratio uses the forward earnings of the company to calculate the PE ratio. In this case, it will be using in this case, what people does is that they will project the earnings 12 months forward, and then use that figure to compute the PE ratio. The second type will be trailing PE ratios, and as the name suggests, it is more backward looking. So in this case, what the PE ratio that we are calculating right now is trailing PE ratios, because we are actually using the 2019 figure, which is a historic figure, to calculate the PE ratio of the company. One thing I would like to highlight about PE ratio is that it will only work for companies that demonstrate consistent earnings. So in this case, it actually works because the earnings is actually rather consistent year over year. And for some companies, you may have to make some adjustments to the profit attributable to owners of the company's figure, because there may be one-off items for that particular year. One very common example would be in the case of a real estate company where it owns investment properties. and every year there will be huge revaluation gain or loss depending on the performance of the property market for that particular year. And that is actually not indicative of the actual economic performance of the company, and hence we will have to strip that out before performing our calculation for PE ratios. Another example would be the impairment value that I was talking about just now. So in the case of an impairment and assets values are indeed written down, there may be a huge impairment expense sitting on the profit and loss statement of that company for that particular year. And we do know that such impairment is one-off, hopefully it's one-off, and it's recommended that you remove that particular item from the profit and loss figure before you compute your PE ratio, because we want a PE ratio to be representative and to be representative and to be so that you are able to compare apple to apple across the different years. If you would like to look at PE ratios from time from different time horizons, from different in different time points. Okay, the next statement we'll be looking at will be the cash flow statement. One important figure we are looking out for in this statement is the free cash flow figure. This figure does not appear on the statement itself, but rather you need to perform some calculation to derive this figure. So free cash flow, according to Investopedia, is defined as the cash a company produces through its operation less the cost of expenditure on assets. So what it means is that you actually take the cash generated from operating activities, which is cash from operations, and you take this figure and subtract it with the capital expenditure, and that will be items such as purchases of PPE and purchases of that intangible asset. In this case, we will take 354 million minus away 27 million and 690k. So that will give you about 330 million ish. This 330 million ish is actually the free cash flow generated by the company in the year of 2019. And cash flow is very important to a company because cash flow is the lifeblood of a company. Without cash flow, the company will not be able to survive. And hence, it's very important to ensure that the company that you are invested in is consistently generating positive free cash flow. A good gauge of free cash flow would be we will usually look at the free cash flow yield. So what we do is that we take the free cash flow generated by the company and divided by the market cap of the company. In this case, the free cash flow is 330 million, and the market cap of Greatview Aseptic Packaging is about 535 billion. That will mean that the free cash flow yield is slightly above 5%, around 6 to 7%, and that is actually an acceptable figure. Usually, when I invest in a company, I tend to prefer the free cash flow yield to be around 5 to 10%. Anything above 10% is very ideal, but the minimum figure that I will be looking at for free cash flow would be at least a 5% free cash flow yield. So what it means is that Greatview Aseptic actually passed this test, this free cash flow test, and I'm comfortable with the cash flow that it is generating from its operations. We have almost come to the end of this video. To summarize, I have covered 3 financial statements. They are balance sheet, statement of profit and loss, and cash flow statements. For balance sheet, we want to make sure that the assets of the company are of high quality, and to ensure this, we want to avoid companies with a high percentage of their asset being in intangible assets or in trade receivables. It's okay to have a high percentage of assets in trade receivables, just that we need to make sure that the company do not have any difficulties in collecting and recovering this debt in the prior year. For profit and loss, we need to ensure that we do not overpay for the company's earnings. For a growth company, it's okay to pay more than 15 times PE. In the case of Greatview Aseptic Packaging, it is a dividend paying company. So the maximum PE ratio that I will be paying for would be 15 times earnings. Anything more than 15 times earning is considered expensive. Lastly, for cash flow statements, we want to ensure that the company is generating positive free cash flow on a consistent basis. As what I've shared with you, the free cash flow yield that you are looking at is between 5 to 10%. So the minimum cap is actually 5%. Anything lower than 5% will mean that this company is extremely bad at generating cash flow. And this is actually a warning sign that you should take note of, because cash flow is the lifeblood of the company. Without cash flow, the company will not be able to survive. Hence, we need to have a requirement that the free cash flow yield has to be at least 5% to qualify as a good investment. Thank you for watching my video. If you have any comments, please leave it on the comment box below and I will address them personally. Thank you.